All right, welcome to our Talk Tickers briefing. Today, we're jumping right into the Q3 2025 earnings call for BioCardia, a clinical stage cell therapy company that's got a lot going on. So right off the bat, we've got a real head-scratcher here. On paper, things looked pretty good. BioCardia posted a loss of 24 cents a share, which actually beat what analysts were expecting by a penny. Now, you'd think that's good news, right? Well, the market disagreed. The stock dropped over 3% the very next day. So what gives? Why the disconnect? That's what we're here to figure out. Okay, so to really understand that reaction, we have to peel back the layers and look past that headline number. Let's get into the nitty-gritty of the financials. First up, revenue. And it's a big fat zero. Now hold on, don't panic. This was totally expected. BioCardia is a clinical stage company. They don't have a product on the market yet. The whole story here isn't about what they're selling today, it's about their future potential and, crucially, managing the cash they have to get there. Now, here's where things get a little more interesting. The net loss was $1.5 million. But the key word here is improvement. They actually lost less money than they did in the same quarter last year. What does that tell us? It says they're tightening their belts, running a much leaner ship. And for a company at this stage, that is exactly what you want to see. And that efficiency leads us to maybe the most important number of all, their cash runway. They have about $5.3 million in the bank, which they say will fund everything into the second quarter of 2026. You can almost hear the clock ticking, can't you? This is the deadline. Everything they promise has to happen before that clock runs out. The race is definitely on. So with that ticking clock in mind, let's pivot. We're going to look at what really matters for BioCardia right now. It's not about past performance, it's all about what's coming up. This is what management is calling their catalyst countdown. And look, they are not being shy about it. The CEO, Peter Altman, he came right out on the call and said, the next 6 months promise to be truly transformative. I mean, wow, that's a huge statement. You don't say something like that unless you believe you are on the verge of something really big. So what's backing it up? Okay, so this is their game plan right here. It's basically 4 big bets. First, you've got CardiAMP for heart failure. That's kind of the main event. Then there's a second use for that same therapy. After that is CardiALLO, an off-the-shelf option, and this is the one they're hoping to get government funding for. That's so important because non-dilutive means they get cash without having to sell more shares. And finally, you have the technology that makes it all work, the Helix delivery system, which is also going for its own FDA green light. And here's the kicker. This isn't just talk, it's a roadmap with very, very specific milestones. Just look at how packed the next 6 months are. We're talking a huge meeting in Japan, a big step with the US FDA, the official submission for their delivery tech, and that massive funding decision. It's just one thing after another. This is, without a doubt, a make or break period for BioCardia. Which brings us full circle, back to our original question. If there's this incredible lineup of potential good news on the horizon, why on earth did the stock sell off? This is where we get into Wall Street's verdict and the skepticism that's clearly baked into the share price. And wow, this chart just says it all, doesn't it? The rest of the biotech world has been having a party. The whole sector is up 24% over the last year. Meanwhile, BioCardia is down a whopping 37%. That's not just underperforming, that is a Grand Canyon-sized gap. It tells you everything you need to know about how the market feels right now. So this is the fundamental tug-of-war. On one side, you have management saying, hey, look at our data. Our path forward is clear. We're being smart with our money. But on the other side, you have the market saying, yeah, we've heard that before. All we see is a history of you needing more cash and selling more stock to get it. And that staggering 60-point performance gap we just saw, that's the price of the market's trust issue. They just aren't buying the execution story. At least, not yet. All right, so we've laid out both sides of the coin, the bull case and the bear case. Now it's time for us to make the call. What's our rating, and what do we think happens from here? Ultimately, when you boil it all down, it comes to this one single question. Do you believe management can hit all these targets and navigate this gauntlet before that cash clock we talked about hits zero? It's that simple. Are you a bull or a bear on their ability to execute? Let's break it down. The bull case is pretty exciting. A positive update from regulators could send the stock soaring. Securing that free NIH money would be an absolute game changer. And getting the Helix system approved takes a huge chunk of risk off the table. Now, the bear case is basically the mirror image. Any delays, rejections, or a no on the funding, and they'll almost certainly have to sell more stock, which could push the share price down even further. So, after weighing everything, we're landing right in the middle. Our official rating on BioCardia is market perform. And here's why. With so many potential home runs coming up in just the next 6 months, you just can't be outright negative on the stock. The upside potential is just too real. That's why we're not saying underperform. But, and this is a big but, the company's history and the huge execution risk involved mean we just can't get too excited yet. Calling it an outperform feels too aggressive right now. So the key takeaway is this. If you're watching this stock, buckle up. It's going to be a very bumpy, very volatile ride as each piece of news drops. And as always, we have to end with this very important reminder. This is not financial advice.